Welcome to Binance Academy's DeFi Deep Dive course, where we'll explore the core concepts of decentralized finance across three comprehensive sections: DeFi fundamentals, DeFi in action, and DeFi opportunities and challenges. In Module 1.1, we'll start with a refresher on what DeFi entails and how it differs from traditional and centralized finance. DeFi refers to an ecosystem of decentralized financial applications built on blockchain networks. Its primary objective is to create an open-source, permissionless, and transparent financial ecosystem that's accessible to everyone while operating without any central authority. It's easier to understand DeFi when comparing it to TradFi. TradFi is a catch-all phrase that refers to traditional finance, including the traditional retail banking, commercial banking, investment banking, and related financial services sectors. They include the bank branches we visit and the banking apps we use. Their hallmark is centralized control of every aspect of financial services provision. The main differences between DeFi and TradFi include accessibility, censorship resistance, regulation, and customer protection. While DeFi is transparent and accessible to anyone with an internet connection, TradFi often requires stringent Know Your Customer or KYC checks. In terms of censorship, DeFi is censorship resistant as there is no central authority capable of banning users, while TradFi remains susceptible to censorship, where banks can restrict access or ban users. TradFi stands out for its high level of regulation, overseen by central authorities, and it offers substantial customer protection through established legal frameworks. In contrast, DeFi is still in its experimental phase and lacks comprehensive regulatory guidelines. Consequently, users need to be vigilant and take precautions, as DeFi typically does not provide the same level of customer protection as found in traditional finance. DeFi and TradFi represent two fundamentally different approaches to financial services. What is CeFi then? In the context of the cryptocurrency industry, centralized finance pertains specifically to financial services offered by centralized cryptocurrency exchanges. While DeFi operates without a central entity and emphasizes user ownership of private keys, full custody of funds, and smart contract interactions based on code rules, CeFi takes a different approach. In CeFi, centralized exchanges act as custodians, and users typically don't own their private keys. Instead, they entrust the exchange to safeguard their assets and provide various financial services. In the cryptocurrency industry, DeFi and CeFi serve distinct roles, each offering unique advantages and limitations. CeFi appeals to average users due to its user-friendly interface and lower technical requirements. It provides convenience and access to a full range of services, making it suitable for both novice and sophisticated traders. With deep liquidity, CeFi platforms support active trading, and they offer fiat to crypto on-ramp and off-ramp services. Notably, since CeFi platforms hold user funds in custody, users have the benefit of account recovery in case of lost passwords or incorrect transactions. In contrast, DeFi demands a higher level of technical expertise. Users maintain control over their private keys, offering them full autonomy, but also responsibility. This means that if private keys are lost, funds are sent to the wrong address, or if there is a breach in DeFi services, there is typically no recourse. DeFi is an experimental and riskier space, requiring users to navigate the ecosystem with caution to safeguard their assets. Despite these limitations, DeFi has the potential to bring financial inclusion and freedom to more populations globally. As of 2023, the leading decentralized exchange, Uniswap, has even surpassed one of the largest centralized crypto exchanges in spot market trading volume, signaling the robust growth of the DeFi space. Common DeFi use cases encompass borrowing and lending, decentralized exchanges, liquidity provision, staking, and yield farming, which we will delve into further in Section 2. However, DeFi's applications extend beyond these examples. Decentralized monetary banking services, including mortgages and insurance, have the potential to remove intermediaries and reduce costs significantly. Furthermore, the DeFi ecosystem continues to explore numerous other use cases, reflecting the ongoing innovation and evolution within this exciting domain. Accessing DeFi services is relatively straightforward. All you need is a cryptocurrency wallet and some cryptocurrency assets. Wallet options are plenty, including browser extensions like MetaMask, mobile wallets such as Trust Wallet, and numerous others. However, it's important to note that DeFi services often run on different blockchain networks. For instance, using dApps on the Binance Smart Chain usually requires BNB to pay for transaction fees, while DeFi services on the Ethereum network require Ether for the same purpose. These fees compensate network validators for securing the blockchain. Conveniently, some centralized cryptocurrency exchanges also offer access to DeFi services within their platforms. This option can be advantageous for users seeking simplicity, although it may come with trade-offs like potentially higher fees. In the next module, we will go back in history to review the evolution of the DeFi sector